Welcome to Afra Global 24, your trusted source for breaking news, deep insights, and stories shaping Africa and the world. Stay informed, stay connected, and experience the news that matters. Right here, 24/7. For decades, the United States held a lofty status in the global financial order. Its currency, the dollar, was the unquestioned reserve standard. Its bonds were considered the safest assets on earth. Its institutions, Wall Street, the Federal Reserve, the Treasury, shaped the fate of nations. But beneath that facade of dominance, a critical fault line was growing. By 2025, that fault had cracked open. The U.S. national debt had ballooned to $36.2 trillion, representing more than 120% of the country's annual economic output. The warning signs, rising interest rates, premiums on risk, geopolitical pressure, were unmistakable. This crisis would stretch far beyond the halls of Congress and the ledgers of Wall Street. It would become the spark for a seismic shift in global capital flows, one that would propel Africa into a new era of financial agency. This is the story of how America's debt implosion gave birth to Africa's new financial empire. The numbers alone tell a story of mounting stress. The U.S. federal budget had long operated under structural deficits, spending more than it collects in taxes. The gap was filled by issuing treasury bonds, rolling over older debts, and compelling lenders across the world to purchase U.S. debt. But that model came with hidden costs. By 2024 and 2025, interest payments alone moved past $1 trillion per year, consuming a growing share of federal revenue. The creditworthiness metrics that once made U.S. treasuries nearly risk-free began to flicker. Ratings agencies issued warnings. Yields climbed. The dollar, once the safe harbor of global finance, started showing signs of strain. Foreign holders of U.S. debt, countries including China, Japan, and European states, began voicing concerns. Some quietly diversified their reserves away from pure dollar exposure. Meanwhile, Congress stumbled in passing long-term fiscal reform. Emergency funding and temporary extensions replaced structural discipline. It was in this moment of vulnerability that alternative financial powers began to emerge, not from the traditional capitals of Europe or Asia, but from a continent long relegated to the margins of global capital, Africa. For most of modern history, Africa's role in the global economy was defined by raw extraction, mineral wealth, agricultural exports, and labor. But the early 2020s saw a strategic reorientation. African governments and regional institutions began to imagine economic sovereignty not as a distant ideal, but a viable target. Across the continent, initiatives were spearheaded to harness natural resources, digital innovation, and regional cooperation to chart a new path. The African Union, in coordination with the African Development Bank, launched exploratory plans for a unified financial infrastructure, one that would reduce dependence on Western capital markets. Nigeria, South Africa, Kenya, Ghana, and Ethiopia began building regional fintech hubs, interbank settlement systems, and sovereign wealth funds. These efforts, while modest at first, created the seeds of a larger transformation. As the U.S. dollar's dominance faltered, African strategists saw the opportune moment to build a parallel financial architecture grounded in African assets, African trade, and African agency. By 2027, the umbrella concept for Africa's emerging financial architecture took shape, the Pan-African Monetary Alliance, PAMA. Its founding vision, to establish a continental payment and settlement system backed by African natural resources and trade flows, reducing reliance on the U.S. dollar and external lenders. Member central banks would be connected via a digital clearing network, allowing cross-border settlement in local or regional currencies. A continental reserve fund would be seeded by mineral exports, renewable energy revenues, and climate investments. Participating nations would channel portions of their export revenues into value-added enterprise zones, factories, processing plants, green energy hubs. Overarching oversight would rest with the newly formed African Continental Financial Authority, ACFA, responsible for regulation, macroprudential oversight, and strategic investment. With backing from China, India, and Middle Eastern financiers, the capital flows to seed PAMA became possible. Africa's natural wealth, rare earths, lithium, cobalt, gold, and its renewable energy potential became leverage for investment, rather than mere export commodities. The narrative had shifted: wealth generation in Africa, not resource outflow. The U.S. debt crisis hastened this shift. As American bond yields rose and global confidence wobbled, foreign central banks and institutional investors grew wary of overexposure to U.S. treasuries. Capital that once flowed into U.S. safe havens started seeking alternatives. African governments, already building their financial frameworks, presented themselves as newer, more stable frontiers. Their risk-return profiles became more attractive. Sovereign bonds issued under PAMA or related African agencies gained traction. Investors eager for diversification and impact capital allocated funding toward African infrastructure, green energy, and transition projects. Meanwhile, the reliance of many African economies on foreign loans denominated in dollars became increasingly precarious. Currency depreciation or dollar strength could decimate debt servicing capacity. The new African systems offered a hedge, a way to insulate economies from foreign currency risk and predatory lending. Thus, the U.S. crisis acted less like a collapse and more like a catalyst, forcing the acceleration of Africa's financial breakaway. By 2030, the infrastructure was no longer theoretical, it began to distribute power. PAMA's clearing network connected cities from Dakar to Dar es Salaam, enabling trade settlement in African currencies across dozens of nations. The Continental Reserve Fund, seeded by commodity revenues and green bonds, began issuing capital for large-scale projects. In the Sahel, rail corridors were financed through African bonds. In East Africa, renewable energy microgrids sprung up, paid for via African institutions. In West Africa, agro-industrial complexes replaced raw export models. The financial gains were captured domestically, not siphoned abroad. Africa's combined GDP climbed beyond $5 trillion. Its capital markets matured, its banking systems deepened, investment flows returned. And crucially, Africa's dependence on Western credit lines dwindled. The continent had grown a financial backbone, an empire of capital rooted in its own soil. The West did not welcome this shift silently. U.S. and European foreign policy strategists recognized the danger. They attempted to counter with new trade agreements, renewed emphasis on foreign aid, and regulatory pressure on cross-border capital flows. Diplomats traveled through African capitals offering conditional loans and political incentives to slow integration into African systems. Yet Africa's posture was different. These efforts were met with negotiation, not concession. African leaders insisted on transparency, local ownership, and strategic parity. They argued that partnerships must serve African agency, not external dependence. Interestingly, many Western investors adapted. Rather than resisting, they invested in Africa's new financial institutions, but on African-defined terms. The shift wasn't simply one of confrontation, it was rebalancing. America's downfall was structural: fiscal overcommitment, infinite borrowing, over-reliance on its supposed privilege as issuer of the world's reserve currency. Its debt crisis revealed the fragility lurking beneath decades of dominance. Africa, by contrast, sought stability through diversification, sovereign control, and value capture. It did not attempt to mimic the U.S. model, in which power is tied to perpetual debt, but to surpass it through grounded capital, internal trade, and resource-backed investment. This inversion represented a deeper turning point in global finance. The old economy, anchored in external debt, was giving way to a new economy, anchored in internal sovereign. No empire is built without resistance. Africa faced structural obstacles: governance gaps, corruption, infrastructure deficits, political instability, and the legacy of external economic distortion. Skeptics warned that the newly built systems might replicate old defects. Currency valuation risk, divergence in economic development among member states, external pressure from global capital, and climate vulnerability were persistent threats. Yet the difference in this era was intention. African institutions embedded accountability, local participation, and value capture into their design. The model was evolutionary, not extractive. By 2035 and beyond, the world had shifted. Africa's financial networks became alternative poles of capital. The notion that all capital must flow through New York or London seemed archaic. Emerging market blocks realigned. Asian, Latin American, and African institutions increasingly traded in alternative currencies or regional systems. Global institutions restructured, acknowledging Africa's centrality. American debt continued to mount. The dollar weakened in global influence. But the new order no longer collapsed, because there was now a sturdy alternative. History often frames turning points by conflict or conquest. But the 21st century's defining shift may well be financial. It's not war, it's capital that redraws boundaries. America's $36.2 trillion debt crisis was more than a reckoning. It was a turning point, one that birthed a rising financial empire in Africa. An empire not built on borrowed power, but on self-directed capital, indigenous institutions, and a commitment to collective sovereignty. If the future is shaped by who controls capital, Africa is no longer a player. It is a center. This is the new chapter of global finance. And in the rise of Africa's empire, the world is being remade. You've been watching Afri Global 24, your window into Africa and the world. If you found this video informative, don't forget to like, share, and subscribe to stay updated on the latest stories shaping our continent and beyond. Hit the notification bell so you never miss a report. And join the conversation in the comments below. Until next time, this is Afri Global 24, bringing Africa closer to the globe 24 hours a day.